Okay, three. Statistics Canada has three ways to calculate gross domestic product, and let me go through them. Explain the ideas rather quickly. First of all, there's something called by expenditure, which simply means, we think back, we had households consuming, firms investing, government purchases, and then foreigners buying things that are produced here in Canada. So this is the C, I, G, and NX. If we add these things together, then you get GDP by expenditure. The sense of it here would be, imagine when you go to buy something, I think by law now in Quebec, they have to give you the receipt, the little piece of paper that shows that you've purchased something. Well, imagine, and Statistics Canada probably does this, they take a typical household and they collect all those bits of paper during the year, add it all together, and that would tell us what household consumption is. You'd have to do the same with foreign tourists that come to Canada, all the money, all the things they purchase, and then do the same with firms doing investment, government add it all together, you get GDP. Another way to, in a sense, arrive at the same number, a little bit easier maybe, would be to look at how much a household earns. So if you wanted, you could do it that way. You'd have to find out their wage, their income from salaries, if they have a rental property, maybe they have a duplex, they rent out another place, and they'd have to, that's part of their income. Firms, if people are shareholders, they receive dividends, for example. So you'd add this all together. Now, of course, then the issue is, well, some people can spend more than they earn, and they'd have to be borrowing, or they could be spending less than they earn, in which case they'd be saving. You have to make a correction for that. Statistics Canada does all this. Anyway, that's another second method by income. The third method, it's kind of interesting. Let's just look at this quickly. It's called by value added, or by industry. In this case, imagine something like a farmer in Saskatchewan who grows wheat. So the guy has seed, and then he plants it in the ground, and then he grows the wheat, and he sells the wheat to a mill. Right? The mill takes the wheat and grinds it into flour. So at each step, there's going to be like an increase in the value of this particular thing. So then the mill sells the flour to a bakery. Bakery makes bread. And then the bakery sells the bread to, I don't know, probably go a grocery store, and they sell it. So if you looked at the baker, for example, they buy the flour, so you'd reduce that, and you say, well, how much extra value did they add to this particular, same with the Provigo, the grocery store, well, they bought the bread, but then they sold it at a higher price. The difference is the increase in value. And so this, in theory, this should add up to the same thing as the previous two methods. Of course, they never do. And so then Statistics Canada has to play around with the numbers to kind of make them match up. I mentioned this a little bit because this value added is also the way Canada's gross goods and services tax is calculated, which is, it's a complex tax. So that means to say that Revenue Canada, or the Canadian Revenue Agency, has to go and find out each step along the process how much the value added for a particular item was, and then they add the tax to that. There's a process for doing all of this. And so Europe does the same thing, and then they call it a value-added tax. So if you, in Europe, the percentages, in Canada, the GST is 5% at the federal level. In Europe, it's usually higher, it's around 25-30%. Incidentally, it's hidden in the goods. When you purchase something there, then you don't see it because it's part of the price. In Canada, it's added at the counter. The sales tax in Quebec, this provincial tax, is also a value-added tax. It's identical to the GST. There's slight differences, but for us, in effect, it's 15% in Quebec. I'm going to look at this idea of calculating gross domestic product specifically with a very, very simple example, and I'm going to use the expenditure approach. But my example is so simple that I can give you a sense of how the income approach or the value added would work. So let's take a look at this now. So we've got a very, very simple economy, or simple country, that only produces tomatoes, apples, and fertilizer. Only produce three goods. There's no foreign trade. There's no tourists coming, and there's no government in this little simple example I've got. So let's say we've got the year 2010, and we've got the tomatoes sector, the apple industry, and the fertilizer industry, and let's say they produce, 20 kilograms of tomatoes. A household goes and buys those tomatoes, and the market price is $5. So the market value of tomatoes is going to be $100. In this case of the apples, let's say they produce 60 apples or 60 kilograms of apples. Prices, some household buys, family, somebody in the market pays $4. $240. And the economy produces fertilizer. Let's say there's 10 kilograms of fertilizer. It's sold for $9 each. But there's an important point here. The fertilizer is an intermediate good. It's used to produce tomatoes and apples. So it's like McDonald's buying electricity to make a Big Mac. What this means is it's not counted. It's an intermediate good. And the sense of it, too, is that you can imagine the people that produce apples, let's say, they buy the fertilizer to put on the ground to be able to produce their apples. So when somebody buys apples, implicitly they're buying not just apples, they're also buying the fertilizer. So that's why it's not included. So we can now add the market value of the final goods, 100, 240, that gives us $340, and that's the nominal GDP in 2010. Incidentally, I could calculate that $340 by value added. In that case, what I'd do is I'd look at the fertilizer produced. They take it out of the ground and sell it, so that's $90. But then I'd look at, say, the apple industry. Well, it'd be they produce 240 less the cost of the fertilizer produced. The difference would be the value added of apple production, and then I'd add the value added of tomato production. If I were to do it by salary, I'd have the same thing. In this case, I'd be looking at the income less the cost. For example, the apple industry, they have to purchase the fertilizer. That would be a cost, so that would be excluded. So it would arrive at the same calculation. And this extremely simple example is fairly straightforward. So let's jump ahead now to 2011. So in this case here, I've done it quickly. They produced 2060. The price is $7, $4. We can exclude this fertilizer here. I'll just cross it out like this. And here I'm just going to, I put it in, but it shouldn't be there because it's an intermediate good. We can ignore it. So the market value of tomatoes, 140. The market value of apples, 240. And when we add the two together, we get $380, that nominal GDP in 2011. But you'll notice it's increased. It was $340 here, and now it's gone to 380. Sort of implies that the country is producing more stuff. But in fact, or there's more economic activity. But you can see in real terms, it hasn't changed. There's still all that's happened here is that the price of tomatoes has gone up. Now, economists, when they were first calculating gross domestic product or GNP actually at the time in the 1940s and 50s, they understood this problem, and they realized that they've got to fix this somehow. We've got to do something so that we don't get a false impression about what's going on in real terms, in terms of actually producing stuff. So I'm going to do that in a second. Let me jump ahead to 2012 and just see another example. Okay, so we got 2012. Notice I've excluded the fertilizer. I've got 30 kilograms of tomatoes, $7. The market value is 210. Then the market value is $300, and that adds up. So we've got $510 nominal GDP in 2012. Fine. So I'm going to duplicate this table, these three tables, on the next screen. So let's do that. Here, they're exactly the same as before, but now I want to fix this problem of the price change. So let that in, take that out. Here's how economists have solved the problem. And bear in mind that this is not a complete solution. This is how they initially solved it in the 50s and 60s, and they've been revising the solution since. It poses problems on its own. In any event, first step is to choose 1 year. It's the base year. I'm going to choose 2010. It's completely arbitrary. I could pick any year I wanted. I could pick 2011, I'm going to choose 2010. In Canada, we now use 2002. The Americans, they use 2012. I don't know what year is used in France, but and I should say this year it's changed after a certain period of time. They change it as well, but I'll tell you what it is if I'm going to ask you a question to the calculation. How is this relevant? Well, what that means is I'm going to use the prices from this base year. So I've circled out $5 and $4. It's important. So I now apply the prices from the base year in any subsequent year, for example, 2011. So I change these now to 5 and 4, and I calculate this new market value based on the prices from the base year. So it's kind of incorrect to call it market value. So it's sort of like this is kind of a weird thing because it's market value, but based on the prices of a different year. So I'm going to have 20 times 5 is 100. This is going to be 60 times 4 is 240. And now, you'll notice now this is called a real GDP. Because, in effect, what I've done here is I've used the prices from 2010 to calculate gross domestic product in 2011. Should be 11 here, not 2012. Let me do the next one. Once again, I go back to the base year, take the price 5 and 4, and paste it in or use it for calculating the real GDP in 2012. Which means now I'll have $150, 60 times 240, and now I've got real GDP in 2012 is going to be $390. You notice something here, is that for the base year, 2010, what will the real GDP be? Well, it's going to be exactly the same as the nominal GDP because I'd just be using the prices from the base year. So in the base year, these two are the same because I'm going to be using the same. If I were to go ahead to 2013, once again, I'd be using the prices from 2010. So how does a country with Statistics Canada go about choosing? When they choose a base year, they're usually very careful to do a lot of surveys and collect a lot of information about prices so they know exactly what the prices are. Now, this is the relevant information, but I got 7 points I wanted. Some are related to this, some I've already said. Maybe one last point that's unrelated. First, base year. It's arbitrary. I happen to pick 2011 rather, or 2010 in a moment ago. Different countries use it differently. Be cautious about something. I happen to pick 2010 for my example, but I could just as easily pick 2012. It doesn't have to be the first year. It could be anything. Usually it's indicated somewhere. It's indicated somewhere in the data. If you see a table or a chart or something, somewhere at the bottom it'll say base year is equal to whatever year it is. And of course, in the base year, real GDP is equal to nominal GDP. Now, this term nominal and real is one of the key ideas, and I'll come back to it later because it's actually a very significant concept within macroeconomics. I've shown it to you in the situation of context of GDP, but we can see it in other areas as well. But very quickly, often in news reports or in references, they don't say real GDP. They'll say something like constant prices or base year prices or 2010 dollars. Something like that. If they say something like of that sort, then they're referring to real GDP. So they'll say corrected or adjusted for inflation, same idea. It means that they're referring to real GDP. If, on the other hand, they refer to constant or current dollars or current prices or unadjusted for inflation, then that means they're referring to nominal GDP. Got a third point here, growth rates. Now, we saw this earlier, it was 380 and 510. If I ask you for a growth rate, if you know how to calculate this and you're familiar with, fine, use whatever method that works. I'm going to do this quickly here. We've got the nominal growth rate from 2011 is going to be the new price, which is this one here. This is the new price. This is the old price. So we're going to take 510 minus 380. Use your calculator if you want. You can do this calculation, put brackets here, do that first, then divide by 380. And you'll notice you can get a decimal version of this or a percentage version. Same number means exactly the same thing. The question will usually tell you which version you have to provide. 3 decimals is probably, 3 significant digits is probably accurate and good enough. You know, there's 3 significant digits in both answers. Let's do the one with real GDP. In this case, if you notice from before, I had 340, 390, same idea. So it's going to be new minus old, which is going to be 390 minus 340. Again, if you do this with a calculator or your phone, you can see that it'll be equal to, in this case, 14.7%. Now, kind of question is, why is there a difference between these two numbers? You'll notice that I'm calculating the growth rate of the real GDP and the growth rate of the nominal GDP for the same time period. And the simple answer is, well, there was a price change. So implicitly now, what we can say is the difference between these is because of price changing. That's my next point. We've got kind of a measure of inflation, where we mean inflation means a change in prices. And if you want, this is a kind of a very simple equation that you can consider. The real growth rate, we just did a moment ago, was 14.7%. The nominal growth rate was 34.2. That means that the inflation rate would be 19.5%. So we can sort of say that the inflation rate, the measure of inflation in this case here, is about 19.5%. In fact, this has a name. It's known as the GDP deflator. But later in the course, I'm going to look at another measure of price changes or inflation. If we're going to compare GDP in different years, then economists usually suggest using real GDP. The reason for this, of course, is that if prices change, it might give you the false impression that there's a real economic activity. The country is producing more, and we want to exclude that possibility. Real GDP takes into account any price or inflation. There's a problem with this, though, is that as we measure real GDP through time, we're using the prices from a base year, but things change. Some goods become better product. Their quality is different. Some things are new. They're invented. They didn't exist before. Netflix, in 2002, there was no Netflix like on-demand or online videos. It's part of GDP in Canada. So one of the solutions for this problem is to use something called chained prices. What they mean by that is they take the prices, but each year the base year changes a little bit. Well, that kind of defeats the purpose of it, but this is one of the problems that arises. A little point here, too, is to say that if the real GDP decreases for 2 consecutive periods, the 2 consecutive quarters, that means a 6-month period, then, and this is completely arbitrary, often news reports will be that the economy is in a recession. But as I say, this is arbitrary. It's kind of a method of describing what is when the economy has a downturn. Again, the notion of per capita GDP is often, even real GDP is calculated on a per person basis, but keep in mind too that what we're referring to is production. So the P stands for product. So if we talk about an economy able to produce something, it means that it's the total production of the economy divided per capita. So it's not income necessarily. It's what the country is capable of producing. I want to finish this last idea of, we see this often in comparison of corporations and gross domestic product. And they'll often say that a large company like Walmart, for example, is larger than the GDP. I think if you're listed in countries by gross domestic product, it would be in the top 20 or something like that. In the case of Canada, it's about 1/4. So it means to say, I checked this quickly, worldwide sales or revenues of Walmart, about $520 billion US dollars. I mentioned earlier that Canada's gross domestic product, this is in 2019, is about $2.3 trillion. Now, comparing Canadian dollars and US dollars are not the same, so it's about 25, very roughly about 25% or so. Well, let's take a look. Let's take a look to compare Walmart's worldwide sales with. So let's type in GDP by country, and I'll use Wikipedia. So if we look down the list here, 520 billion would be around, somewhere around here. Right in this area here, between Sweden and Nigeria. So it's about the size of Belgium, Argentina, in the top 25, and Exxon is, Walmart is hardly the largest corporations in the world. But this comparison is kind of incorrect. It's incorrect in two very important senses. First of all, what does Walmart do? Well, it's a retail company. I mean, they sell products, but they don't produce the products themselves. They purchase the products in point A and then bring them over to some store, a warehouse, and they deliver them to or sell them to consumers. And they do this around the world. So I checked on this. The term for this in business would be a cost of goods sold. So I just checked to find out. And roughly it's about the cost of the things that they purchase and then put in their stores about $385 billion. So in this case, what we'd be looking at is the value added. That means to say what they do to increase the value of the things they sell, and it's logistics, they bring it to another place, make it available for people to purchase, is about $135 billion. So this would be the proper comparison if we were looking at gross domestic product between Canada, let's say, and a company like Walmart. But this misses a much more relevant point that's far more important, is that Walmart is a corporation that exists to make a profit. It has to. It has no choice. If it makes mistakes and screws, if it chooses to do something other than making a profit, it will lose money and eventually go bankrupt, and it won't exist. And this happens frequently. Management of a company does something wrong. So it's not as if a large corporation is free to do whatever it wants. Furthermore, the relationship Walmart has with its customers and even with its employees is a voluntary relationship. Nobody is forced to go to Walmart and buy things, and nobody is forced to work at Walmart. If somebody doesn't like Walmart, they can quit. So the relationship is voluntary. This is a distinctly different situation than a country. Walmart has one specific goal: make a profit, to survive. Now, Canada, what's the purpose of Canada? Oh, geez. I mean, there's like 30, 35, 36 million Canadians doing all kinds of different things. Each one decides on their own whether they want to do something. They're happy to not doing it. The end result of all these Canadians doing these various activities is this GDP of $2.3 trillion. To the extent it means anything, there's many things that Canadians do that aren't part of that number. But if we're trying to understand the macroeconomy of Canada, well, that's a relevant number, and that's the point.